Hi, welcome to this tutorial. So in this tutorial, we are going to cover the activities ratios. So in the previous discussion, we already discussed liquidity ratios and leverage ratios. So in this discussion, we are going to cover the activities ratios. Activity ratios, also known as efficiency ratios or turnover ratios, are the financial metrics that measure how effectively a company is utilizing its asset to generate the revenue. Think it as a operational performance, as a measure of operational performance. So these ratios are very crucial to evaluating how well management is deploying company's resources to create value. In some cases, the company can be profitable, but some cases it can be inefficient. So it may face liquidity problems or fall behind its competitors. So the activities ratios it's mainly the measure the operational performance of a company. So we will move into first ratio, that is account receivable turnover ratio. This ratio measures how effectively the company is collecting its credit sales or its receivable. Once company generated a credit sale, it is creating receivables. So how effectively, how quickly the company is collecting this receivable. This is the accounts receivable turnover ratio. This ratio measures a company's effectiveness in collecting its credit sales. It shows how many times per period company is collect its average account receivable balance. The purpose of account receivable turnover ratio is to evaluate the liquidity of company's receivable and the effectiveness of its credit and collection policies. The formula for account receivable turnover is net credit sales divided by average accounts receivable. So always use net credit sales. The net sales can be used. Remember to average the balance for balance sheet item. Like if you are comparing one item from income statement and another item from balance sheet, it's always required to average the balance sheet item. That means you have to take beginning balance plus ending balance divided by 2 to get an average. So in this case, in account receivable turnover ratio, the formula is net credits divided by average account receivable. So here we have to average the account receivable. Don't take the account receivable as at a point of time. So how we can interpret the account receivable turnover ratio? A high turnover ratio is generally favorable. It implies that company is efficient in collecting from customers, which is minimizes the risk of bad debt and free up the cash. An extremely high turnover ratio could indicate the company's credit policy is too strict, potentially leading to low sales. And also a low turnover ratio is a warning sign. It suggests that company is struggling to collect the payment, which may lead to cash flow problems and higher bad debt expenses. So if it is higher ratio is generally recommended, generally favorable, that means company is efficient in collecting its receivable. But in case of when an extremely higher turnover ratio, which indicates that credit policy is too strict, a low turnover ratio is a warning sign. It suggests that company is struggling to collect its payment, which may lead to cash flow problems and also higher bad debt expenses. So here is an example for account receivable turnover ratio. A company has net credit sales of 1.2 million and its beginning account receivable 140,000 and ending account receivable was 160,000. So to calculate the account receivable turnover ratio, first we have to calculate the average account receivable. So the beginning account receivable plus ending account receivable divided by 2. That means 150,000 here is the average account receivable. So to calculate the account receivable turnover ratio, 1.2 million divided by 150,000, that means 8. So how we can interpret this 8 mean, how we can interpret this ratio? This company is collected its average receivable balance 8 times during the year. This company is collected, its collection is 8 times of its average account receivable for a year. So now we will move into day sales in receivable ratio or average collection period. This is the translation or conversion of this account receivable turnover ratio, we already calculated account receivable turnover ratio. This account receivable turnover ratio we are converting into number of days. That means the day sales in receivable telling how many days it takes a company to collect its receivable once it is sales. After the sales, how many days it is taking a company to collect its receivables. The purpose of this ratio is to determine the average length of the time that company must wait after making a sales before receiving cash. The formula for this ratio is 365 days divided by average turnover ratio. There is an alternative formula also, ending account receivable divided by net credit sales divided by 365. So a low day sales outstanding is desirable is generally recommended. It indicating that the receivables are collecting quickly. A high day sales outstanding suggests a collection problem. It should be compared with the company credit terms. For example, if the credit terms are 30 days, but the day sales outstanding is 48 days. For example, in this case, the collections are lagging. That means the agreed credit terms is 30 days, but when it's come to reality or day sales outstanding, it is 45 days. That means the collection is lagging when compared to agreed credit terms. So the account receivable turnover ratio is telling, it's taking how many times it is collecting its average account receivable. So when it's come to the day sales outstanding, the same account receivable turnover ratio is converting into number of days. That means how many days it taking to collect its receivables when it is sold. So we can calculate the day sales outstanding by using the same example. Here we calculate the turnover ratio is 8. So the formula for day sales outstanding is 365 days divided by average account receivable turnover ratio. 365 days divided by account receivable turnover ratio. That means 365 divided by 8. That means 45.6 days. So which means this company is taking average 46 days to collect from credit sales. So now we will move into inventory turnover ratio. So in receivable turnover ratio, what we discussed, how many times we are collecting our average receivables per year. So in inventory turnover ratio, how many times the company is inventory is sold and replaced over a period. It is a key indicator of inventory management efficiency. Inventory turnover, receivable turnover ratio is mainly measuring how effectively or how efficiently the company is managing its receivable. But in inventory turnover ratio, it is measuring how effectively the company is managing its inventory. And also the inventory turnover ratio exactly telling how many times the company's inventory is sold and replaced for a period. The purpose of inventory turnover ratio is to assess the liquidity of inventory and identify potential issues with overstocking or slow moving items. The inventory turnover ratio telling the liquidity of inventory, that means how long it is taking to convert that inventory into sales, and is there any potential issues with overstocking or slow moving items. The formula for inventory turnover ratio is cost of goods sold divided by average inventory. So in the exam CMA USA exam, you should use cost of goods sold to calculate the inventory turnover ratio, not the sales. Sales means cost of goods sold plus we are adding a margin also. But in the cost of goods sold, it is the cost. So in inventory also we are stating in cost. So we cannot take the sales to compare the sales to measure the inventory turnover ratio. It should be cost of goods sold. So inventory on balance sheet is recorded inventory on the balance sheet is recorded at cost. So you must compare it to cost of goods sold, not the selling price, for an accurate apple to apple comparison. So how it is interpreting? A high turnover ratio is generally strong sales and effective inventory management. It will minimize holding costs like storage, insurance, obsolescence, and free up cash. An extremely high turnover ratio may signal understocking and potential stock out, leading to loss in sales. A low turnover ratio is a red flag for poor sales or obsolete inventory or overstocking, which tie up cash and increase holding cost. So normally a higher turnover ratio is recommended. That means the company is converting this stock into sales more times. That is high turnover ratio. But a lower turnover ratio means it's a red flag. That means the inventory's movement is slow when it's compared to sales, and sometimes we are overstocking. There is a chance for obsolete inventory, and again it's tie up cash and increase holding cost. So we'll discuss a case. So here the Beta Industries reported cost of goods sold of 750,000. Its beginning inventory was 90,000 and ending inventory was 110,000. So first we have to calculate the average inventory. That means opening balance plus closing balance divided by 2. That is mean 100,000 is our average inventory. So now we can directly calculate the inventory turnover ratio. That means cost of goods sold divided by average inventory. That means 7.5 times. So this company is replaced and sold its inventory 7.5 times its average inventory. So this is how we are interpreting the inventory turnover ratio. So the inventory turnover ratio is pretty simple. How many times the inventory is sold and replaced per year? That's the inventory turnover ratio. Now we are moving to day sales in inventory or day inventory on hand. This same like inventory turnover ratio. That here we are telling in ratio, but in day sales in inventory we are converting that ratio into days. That means how many days the company is keeping its inventory in stock before the sales. This ratio measures the average number of days it takes for a firm to sell its inventory. The purpose is to quantify the average age of inventory and efficiency of the production and sales process. The formula for day sales in inventory, 365 days divided by inventory turnover ratio. There is an alternative formula also, that ending inventory divided by cost of goods sold divided by 365. So when it comes to day sales in inventory, a low day sales in inventory is always preferred, which means the company is converting its inventory into sales quickly. A higher day sales in inventory suggests that inventory is sitting for too long, increasing the risk of it become obsolete or unsellable. This is highly industry specific. For example, a fresh grocery store need a very low day sales in inventory, while a car dealership may have a much higher day sales in inventory. Again, this should be benchmarked and analyzed against with the industry to industry. For example, a fresh grocery store inventory day sales in inventory will be very low, but when come to machinery or car dealership will be much higher than this fresh grocery. So for each business, it should be compared against the industry benchmark or industry standard. So we will discuss a case here. So in the same example we are going to discuss. So we already calculated the inventory turnover ratio is 7.5 times. That means this company is converting or replacing its entire inventory 7.5 times per year. So we are converting that, we are calculating day sales in inventory by using the same example. So the formula is 365 divided by 7.5. That means 48.7 days. So on an average, this company is taking almost 49 days to convert its inventory into sales. So now we are going to discuss accounts payable turnover ratio. The purpose of to evaluate how quickly a company is paying off its trade creditors. It provides insight into company's management of short-term liability. That means the account payable, when we are buying a goods or a material for a credit, so that supplier will be our account payable. So how effectively you are paying that accounts payable, it's calculating in account payable turnover. Turnover is purchase divided by average accounts payable. So how we can find the purchase from an income statement? So normally the purchase will not directly stated in the income statement because it is stating only the cost of goods sold. So to calculate the purchase value from the cost of goods sold, you have to add ending inventory with the cost of goods sold, and you have to minus beginning inventory from the cost of goods sold. So the purchase value is cost of goods sold plus ending inventory minus beginning inventory. This will be your purchase value. A high turnover ratio. High turnover ratio mean we are paying quickly, maybe necessarily to take advantage of early payment discount, but it also mean a company is not fully utilizing interest-free credit offered by the suppliers. Normally the credit is a free source of working capital with a free of cost. So the company has effectively utilized that free credit from the suppliers. So a higher turnover ratio normally indicate that company is paying its payables quickly to take the advantages of early payment, but it's always remain that the most of the cases the payable is a free source of working capital or free cost working capital, so it should be managed and utilized effectively. A lower turnover mean if we are paying slowly can be acting a free source of short-term financing. However, if it is too slow, it can damage the relationship with the suppliers and harm the company's credit rating. Even if it is a low turnover ratio, that means the company is utilizing its free source of short-term financing. Again, if it is too slow or we are breaching the agreed terms with the supplier, it can damage the relationship with the suppliers and it can harm the company's credit rating also. So there should be a optimum level for the account payable turnover ratio. It should be managed very effectively by considering all these factors. So we'll discuss a case. So in this case, the company cost of goods sold is 500,000 and the beginning inventory was 70,000 and ending inventory was 80,000. And the beginning account payable 45,000 and ending was 55,000. So first thing we have to calculate the purchase. So how we will calculate the purchase? Cost of goods sold plus ending inventory minus beginning inventory. Here the cost of goods sold is 500,000 and the ending inventory was 80,000 and the beginning inventory was 70,000. So you'll get the purchase value, that is 510,000. So now we have to calculate the average account payable, that is the ending account payable was. Now we have to calculate average account payable. So the beginning account payable was 45,000 and ending was 55,000. That means 50,000 as an average. So the account payable turnover ratio 510 divided by 50, that means 10.2 times. That means how we can interpret this ratio mean this company is paying its average payable balance 10.2 times during the year. If we consider a year, it's paying its total payment to its creditors is 10.2 times of its account payable balance. So now we'll move into next parameters, that is day purchase in account payable. So this is very similar to account payable turnover ratio. So the same ratio we are converting into number of days or days. That means it's just calculating how many days it is normally we are taking to pay and set off our payables or creditors. So the purpose of this ratio is to measure the average times from the purchase of inventory on credit to payment of cash. That means from the purchase of inventory to the payment of cash. It is calculating how many days average time it's taking to from purchase of inventory to the payment of cash. So the formula for day payment outstanding is 365 days divided by our account payable turnover ratio. This should be analyzed in the context of credit terms offered by suppliers. It should be strategically managed and it should be a key parts of working capital management, because the payable is a free source of working capital to the company, but again it should be properly managed and analyzed to avoid the conflict with the suppliers and to maintain the good healthy relationship with the suppliers and secure good deals with the supplier. So we'll move into a case. So in the same previous example, we have discussed the AP turnover ratio is 10.2 times. So we are just converting that ratio into number of days. That means 365 days divided by 10.2. That means 35.8 days. So how we can interpret this 35.8 days, which means this company is taking average 36 days to pay its suppliers. Just assume if this should be, we should be compared with our agreed credit terms with the supplier. If the agreed net credit terms is 30 days, this company is missing out on discount and also paying 6 days late, which could be problematic in some cases. So it should be analyzed by supplier to supplier with agreed credit terms with the supplier. So now we'll move into operating and cash cycles. The operating cycles measure the time it takes a company to convert its inventory into cash and cash into sales. The operating cycle measures the time it takes for a company to convert inventory into cash from sales. That means operating cycle means how many days a company is taking to convert its inventory into sales and that sales into cash. So the formula for operating cycle is day sales in inventory plus day sales in receivable. That's our operating cycle. That which is measuring how many days it is taking a company to convert its inventory into sales and sales into cash. The interpretation, normally the lower operating cycle definitely should be a better because the company needs less time to generate cash from its core operation and reducing the need of external financing or reducing the need of external additional working capital. For example, we'll discuss a case. For example, a company has day inventory outstanding 49 days and day sales outstanding 46 days. So in this case, the operating cycle is 49 days plus 46 days. That means 95 days. That means this company needs 95 days to convert its inventory into sales and sales into cash. Now we will discuss cash conversion cycle or net operating cycle. The cash cycle takes the operating cycle one step further by factoring company's payment schedule to its own suppliers. It measures the length of time the company's cash tied up on the working capital. The cash conversion cycle means how many days the company's cash is tied up in the working capital. To determine how long a company has to finance its inventory and receivable from source other than suppliers. This is crucial measure of liquidity and management efficiency. The formula for cash conversion cycle is, so first we have to calculate the operating cycle. That means day sales in inventory and day sales in receivable, and you can reduce day sales or day purchase in payables. The interpretation, definitely the cash conversion cycle should be shortest as possible. A shorter cycle means the company needs less time to run its working capital back to cash. And some cases there should be a negative cash cycle also. Just assume a case we are getting credit from the supplier. Just assume a 60 days credit from the supplier, but we are giving 30 days credit only to our customers. That means in this case there should be a negative cash cycle also. This occurs when a company collects cash from the customer before it has to pay its supplier. This is essentially means the suppliers are financing the company's operations. If a company have negative cash cycle, which means the suppliers are financing its working capital. So let's discuss a case for cash conversion cycle. Just assume the day sales in inventory is 49 days, day sales in receivables 46 days, and day payable outstanding 36 days. So first we have to calculate the operating cycle. So you have to calculate the day sales outstanding in inventory and day sales outstanding in receivable, that is 95 days. That means 49 plus 46 days. So from there we can calculate cash conversion cycle, that this 95 days minus 36 days. This is days payable outstanding. How we can conclude this? This company is cash tied up for 55 days in each cycle. For this 55 days, the company must finance its operation through other means, such as line of credit or its own equity. The reducing this number is a key goal for financial managers. That means it should be reduced as much as possible. So because if it is reduced, we need only small working capital requirement to finance its operations. So we discussed operating cycle. Operating cycle means how many days it takes to convert its inventory into sales and sales into receivable. And the cash conversion cycle, we discussed how many days the company has to finance its operation or working capital without considering the payables. Cash conversion cycle means the number of days the company should finance its working capital or its operation without considering the day payable outstanding. That without considering the creditors. So now we'll move into overall asset efficiency ratios. Asset efficiency ratios mean how effectively the company is utilizing its asset to generate more revenue. The first turnover ratio is total asset turnover ratio. This is measuring how effectively a company is utilizing its total asset to generate revenue. The purpose of the asset turnover ratio is to answer for every dollar of asset invested, how many dollar of sales the company is generated. The asset turnover ratio is telling if I invested $1 in total asset, how many dollar you generated, how many dollar of sales you generated. So the formula for asset turnover ratio is sales divided by average total asset. A higher ratio generally indicate a greater efficiencies. That means the company is generating more sales when it's compared to assets. Again, this ratio can be industry dependent. A retail company with a low margin product will have a high asset turnover. Again, a capital intensive company like heavy manufacturers will have a low asset turnover ratio. There should be, it is most useful for comparing against industry average or company's own industrial trend. Again, this should be that benchmark for this asset turnover ratio can vary from industry to industry. For example, a retail company should be very high asset turnover ratio. When we are comparing, if you are taking a highly capital intensive industry like a big manufacturer, it should be lower, comparatively lower. So each company asset turnover ratio should be compared, should be analyzed against the industry benchmark or historical trend. So let's discuss a case. Delta Corp had a sale of 5 million. Of its beginning total asset were 2.3 million, where the ending total asset were 2.7 million. So the formula for asset turnover ratio is sales divided by average total assets. So first we have to calculate the average total asset. So the average total asset in this case is 2.5 million. That's the beginning asset. Beginning asset is 2.3 million and the ending asset is 2.7 million. That is, the average will be 2.5 million. And now we can calculate the asset turnover ratios. The turnover of sales in this case is 5 million divided by average total asset. That means 2.5 million. So in this case, asset turnover is 2. That means, which we can interpret that the every $1 company invest in asset, we are generating $2 sales. Now we will move into next ratio, that is fixed asset turnover ratio. It is very similar to asset turnover ratio, total asset turnover ratio, but in the fixed asset turnover ratio, we are considering only the fixed asset. That means fixed asset turnover ratio, how company effectively utilizing its fixed asset like property, plant and equipment to generate the sales. The purpose is to assess the efficiency of a company's investment in its fixed asset. The formula for fixed asset turnover is sales divided by average net fixed asset. So the interpretation, generally the higher fixed asset turnover ratio is considered. That means the company is generating more sales when it's comparing with the fixed asset. A lower ratio can be a indicator, a warning sign. That means there should be some idle capacity or over invest in the property, plant and equipment. So it should be analyzed with the industry benchmark or with the previous or historic performance to get a better insight. So let's discuss a case for fixed asset turnover ratio. So this company have beginning fixed asset 1.4 million and the ending fixed asset 1.6 million and the sales were 5 million. So first we have to calculate the average net fixed asset, that means 1.4 million plus 1.6 million divided by 2, that is 1.5 million is the average fixed asset. So we can directly calculate the fixed asset turnover ratio from here, that means sales divided by average fixed asset, that means 5 million divided by 1.5 million, 3.3. So what it indicates that this company is generating $3.3 sales for every $1 invest in net fixed asset. So this is about today's discussion. So what we discussed today is activities ratios. Just summarize the discussion. So the core purpose of activities ratio is to measure how effectively the company uses its asset to generate sales and cash. This is the core purpose of activities ratios. The activity ratios also known as efficiency or turnover ratios. So the key activities ratios are account receivable turnover ratio, which is related to receivable management. It's measuring how quickly customers pay their bill. So when it comes to inventory management, the inventory turnover ratio or day sales in inventory measure how many days the company is keeping its inventory when compared to sales. So in inventory management, the inventory turnover ratio telling how many times the company is replacing its inventory when comparing to sales. When it comes to payable management, the account payable turnover ratio or day payable outstanding show how long company to take to pay its own suppliers. The cash conversion cycle. The cash conversion cycle is a key metric to calculate how many days of cash or operation should be financed without considering the payables. That means how many days of operation company should be financed by using external or equity fund. Also, it reveals that how many days a company's cash tied up in operating cycle. The overall asset efficiency, the total asset turnover and fixed asset turnover provide a big picture how company generating the sales by using its long-term and total assets. So again, a common logic is that when we are comparing a value from income statement and another value from the balance sheet, the balance sheet item always averaged. Again, the goal of activity ratios is the ultimate goal of measuring the activities ratios. The ultimate aim of managing these activities is to shorten the time take to convert investment in inventory and receivable back into cash, thereby improving liquidity and reducing the need of external financing. The ultimate aim of analyzing this ratio is to reduce the number of days that investment in inventory and also in receivable, and also quickly converting this inventory and receivable into cash. Again, all these ratios, the context is very crucial because all these ratios should be compared with the industry benchmark or historical trend. A ratio itself is a very limited meaning because it should be compared with the industry benchmark or the company standard or the historical performance to get a better idea. Again, it can be vary from industry to industry or company to company. So this is about the activities ratios. So if you have any doubt or you need extra clarification on any of the topics, please let me know and please comment on the comment section. Again, I'm providing a link to download this PDF material. Thank you for watching this video.